If I had a dollar for every time a buyer told me, Sean, I'm just going to wait until rates drop into the fives, I wouldn't be I wouldn't be recording this video. I'd be on a yacht someplace in the Mediterranean. And look, I get it. 7% feels expensive. 6.5% feels annoying. 5 something feels safe. But after closing thousands of loans over 36 years, I've learned something the hard way. And that is that the housing market has a nasty habit of punishing people who try to time it perfectly. So today I want to show you the math that no one really talks about. I call it the 5% trap. And that's the reason why waiting for a cheaper rate is about to make your house much more expensive, not less. Before we talk about rates, I kind of feel like we need to talk about supply. That's economics 101. And right now, the US is short nearly 4 million homes. Look, that didn't happen overnight, and it's not going to get fixed anytime soon. Now, here's the important part. Higher mortgage rates have been acting like a lid on a boiling pot. They have suppressed demand. A lot of buyers have been sitting on the sidelines, probably much like yourselves. But what happens when that lid comes off? What happens when the headlines all read mortgage rates drop to 5.875, which in some areas and on some transactions they already have? Well, all those sideline buyers, they don't just trickle back into the market. They all stand up all at once and they rush for the door. Let's stop talking theory and actually do the math. So take a look at this scenario. Scenario A, buying today with the scary rate. So you buy a $500,000 house at 6.5%, and based on different factors, in the transaction, your credit score, down payment, property type, occupancy, whatever. Your principal and interest payment after the 20% down would be $2,528. That number makes a lot of people uncomfortable, and I get it. So let's look at scenario B, waiting for your dream rate. Now you waited 6 months, the rates dropped to 5.75%. Great headline, everyone cheers. But here's a trap. Because demand just came roaring back, that same house isn't $500,000 anymore. Upward pricing pressure due to the increased number of buyers jumping back into the market caused that home price to rise 6% higher, which is actually conservative. So now it's $530,000, which after 20% down at 5.75%, that higher price, your payment is about $2,474. So let's pause right there for a second. You waited, you stressed, you timed the market, and you saved $54 a month. $54. But to get that $54 savings, you paid $30,000 more for the house. And you had to put $6,000 more down if you're trying to put 20% down. Or maybe because of the increased price of the house, maybe now you can't put 20% down and you have a PMI premium or whatever the case might be. So that means your break even to recover the extra cash that you had to put down, your break even time is about 9.3 years. So here's the kicker. The average home owner only stays in their home for about 11.8 years. So in real life, how much did you really save? And we're not done, because now due to the higher price, well, your property taxes are higher, your homeowner's insurance is higher, and worst of all, you missed out on the appreciation that happened while you were sitting on the sidelines. And all of the math assumes something else that's optimistic. It assumes that you actually get the house when you put the bid in. Because when rates fall, prices don't just rise, competition explodes, it heats up. And you've heard me say this maybe before, for every 1% decline in rates, 5 million home buyers re-enter the market. I've seen this cycle over and over again, and maybe you have too. You see multiple offers. You see escalation clauses. You see waived inspections. When the market heats up, you don't ask for closing costs. You don't ask for repairs. And sometimes you don't even get time to think. Right now, whether it feels like it or not, you're the popular one at the dance. Sellers need you. They need buyers. You have leverage. You can negotiate. If you need to, you can ask for the seller to buy down your interest rate or pay closing costs or get a better price on the house overall. But when rates drop, that power disappears and the seller becomes the boss again. Look, I'm not trying to tell you got to rush in and buy a house. This is the biggest purchase of your life, whether it's your first home, a vacation home, or an investment property. If you're not financially ready, then don't buy, period. But if you are ready and you have the down payment and you plan to stay in the home or keep the home for 5 or 10 years, don't let an interest rate scare you out of building long-term wealth. You date the rate, you marry the house. You can always refinance at a later date if the rate goes down and improves enough to make it worth it. But you can't renegotiate the purchase price once you sign the papers. I'm Sean Biggins. I help people navigate the real estate and mortgage maze without the noise and all the confusion. And if you're trying to figure out whether waiting for a lower rate actually makes sense for you, I built a side-by-side mortgage comparison spreadsheet that lets you run the numbers yourself. You can compare different home prices, different loan amounts, different interest rates to see the real monthly payment difference and understand the break-even point before you make a decision. I'll link it below. It's free. Feel free to share it with your friends. I hope this video has helped you, and I hope you'll like this video so I can help many more people. Let me know what you think in the comments, and thanks again for watching, and I'll see you in the next one.